Hi, everyone. My name is Vivian Leong, and I am the Principal of Taxation at CPA Canada. I'd like to introduce you to my co-presenter today, Bruce Ball, who is our Vice President of Taxation. Hi, Bruce.
Hi, Vivian.
We want to welcome you to our second special COVID-19 tax measures update. Many of you may have seen our first update recorded a few weeks ago, where we talked about all the COVID-19 tax measures that were announced to date. A lot has evolved since that time, as many of you may know, in particular with the Canada Emergency Wage Subsidy, and that will be our focus for today. Before we get started, I did want to mention that there are two key resources you should check out if you haven't done so already. The first is our blog on the Canada Emergency Wage Subsidy, and the second, a summary of issues related to the program. Both of these items are posted on our website, and our presentation today is based largely on these two documents, and they can provide you with a lot more detail than we'll be able to cover in today's session. Today, we're going to keep it to giving you an overview of the basic computations around the subsidy. They're going to highlight the key issues and concerns we've heard around the program. Finally, we're going to spend some time addressing some of the top questions we've heard from all of you over the past few weeks with regards to the program. One final thing before I turn it over to Bruce. Canada Emergency Wage Subsidy is a bit of a tongue twister, and so for the balance of the presentation, when we refer to subsidy, we are indeed referring to this particular subsidy. So with that, I'm going to turn the next slide over to Bruce.
Well, thank you, Vivian. Just before we get into the rules, I wanted to do just a quick update introduction on the work that we've been doing at CPA Canada. We mentioned in our first recording that we've had regular contact with the CRA, and we're continuing that. We're having regular meetings and by conference call, and we're also exchanging notes and phone calls on a regular basis as well. So that work's continuing, and as part of this, we've been working with the Canadian Tax Foundation as well in terms of consolidating issue lists. So we have one for tax issues generally, and we have another one on the subsidy. Just a note on the subsidy listing so far, these were the issues that were recognized before the legislation came out, and we posted that originally April 6th and posted another version subsequent to the release of the legislation. So we've done an update on the existing issues. We're also working on a list of a number of other issues, and I'll talk about that a bit more a little further into the presentation. I did want to talk a little bit about questions and issues that you've been forwarding on to us. It's great. We've had great interaction with the members and good connection as well. We did want to mention, though, we've had, I think, over 500 specific questions and queries come in. I did want to point out that unfortunately we're not able to answer all those questions individually. What we're trying to do is point people to maybe where more resources are when we can. And we're also watching the questions to make sure we raise them with the government if there are issues that need to be addressed or areas where more guidance could be provided by the government. But unfortunately, we're not really able to answer specific fact-based questions or questions where people are asking for specific guidance on how to apply the rules at this point. But we will try to make sure that we forward more information generally on our tax update page, which is being kept up to date each day as things change. So that's really where to go look for information. And as I say, we'll forward issues onto the government as needed. So on that note, I'm going to turn it back over to Vivian to start talking about some of the details of the subsidy.
Great, thanks, Bruce. So just as a very quick recap, because so much has happened over the past few weeks with regards to the subsidy, any of you who've been following along might recall this subsidy was first announced on March 27th by the Prime Minister, where he indicated an additional 75% subsidy would be provided and indicated details would follow. From there, Finance Canada released two different backgrounders, one on April 1st and the second on April 8th. Then legislation was introduced through Bill C-14, which was introduced, tabled, and enacted all on that same day. Finance went back to update the April 8th backgrounder with the final legislation. With rules coming out somewhat piecemeal and kind of changing along the way, there was definitely lots of questions, confusion, and uncertainty in how the rules would apply. And so that list that Bruce just referred to on our website kind of summarized all the issues that we had, and those were shared with Finance and CRA. It appears that Finance heard a lot of the feedback from us and from other organizations, and the final legislation is quite different from what was first announced. Many of the issues raised were addressed in the legislation, however, there's still areas of uncertainty. Also, the rules are quite complex with 5 pages of definitions and 7 pages of actual computations. So we're going to spend the next few moments going over the basics of how the subsidy will be calculated. The first thing employers need to determine is whether they're an eligible entity. And eligible entities are defined in the legislation, and it includes individuals, taxable corporations, partnerships consisting of eligible entities, MPOs, and registered charities. The legislation also includes in its definition prescribed entities, so we wonder if perhaps this gives some flexibility to include any other organizations that may have inadvertently been missed from this list I just mentioned. Finally, there is no size test, unlike the temporary wage subsidy, as you might recall, that was geared for smaller CCPCs, and also this would span across employers across all sectors. So once you've determined whether you're an eligible entity, the next thing an employer must determine is whether they pass the revenue test. In general, this test requires employers to show that they have a drop in sales of at least 15% in March and 30% for April and May 2020. There are 2 possible benchmarks that an employer can compare this to. The default benchmark, which is really the year-to-year comparison, would ask employers to compare March, April, May 2020 to the same months in 2019. The second option is for employers to compare March, April, May 2020 to the average revenue for January and February 2020. The second option, comparing to the average revenue, can be done so by making an election, or if you were not, or if the employer was not carrying on business as of March 1st, 2019. This second option was a new feature that was added in, I think, the second backgrounder. And it really was in response to the feedback Finance heard, in that a year-to-year comparison may not be that indicative of a measure for a business downturn for some businesses. So this change was welcome. The other change that you might recall was that when it was first announced, the March test required a 30% downturn in sales as well. And the feedback was, given that many of the COVID-19 measures didn't really come into effect until mid-March, having employers meet a 30% downturn in sales might be unreasonable. So again, Finance changing that to 15% was welcome as well. Finally, I want to mention that the legislation introduced a new feature where if an employer is found to be eligible for a specific period, it would automatically be deemed to qualify for the next period. So this feature helps provide some greater certainty to businesses that they will qualify for the upcoming month without having to necessarily predict future revenues. It also helps ensure that businesses won't fear trying to recoup some lost revenues in the following months in the fear that they may lose out on the subsidy. So what revenue qualifies? This is generally covered under the definition of qualifying revenue in the legislation. And in that definition, it indicates that it includes the inflow of cash, receivables, or other consideration arising in the course of ordinary activities in Canada. It specifically excludes extraordinary items and also excludes amounts derived from non-arm's length parties. The rules also indicate that an employer can compute their revenue under normal accounting practices. The rules allow employers to elect either the cash method of accounting or accrual method, but once you make that election, you must stick with it for the duration of the program. The legislation also provides some clarity for MPOs and charities in that they can decide whether or not they want to include revenues from government funding. But again, once they make that determination, they must stick with it for the rest of the program. In this definition of qualifying revenue, there are a few areas of uncertainty, namely terms like ordinary activities, extraordinary items, and normal accounting practices aren't defined terms in the legislation, so some guidance may be required here. Also, I want to mention that the definition specifically excludes non-arm's length revenues from non-arm's length sources, which mirrors what was stated in the previous backgrounders. But this has raised quite a bit of concern that many businesses may be left out of the subsidy because of this exclusion. The final legislation introduced includes some special rules for corporate groups and revenues from non-arm's length sources, and Bruce is going to get into that in further detail later on. So this slide here is really reproduced from what is presented on the Finance Canada website. And what it really is trying to do is that illustrates the claiming periods, the required revenue reduction for that period, and the reference period for which to perform the revenue test on. So if you take a simple example, let's assume that the employer has decided to use the default comparison as their benchmark, so i.e. the year-to-year comparison. So to be eligible for the March 15th to April 11th claim period, period 1, the employer must show a 15% decline in revenue for March 2020 by comparing its revenue to March 2019. Assuming that they qualify in period 1, for period 2, April 12th to May 9th, the deeming provision would automatically qualify this employer for period 2. For period 3, May 10th to June 6th, the employer would have to redo the test and ensure that they would qualify by comparing May 2020 to May 2019 and showing that they had a decline of 30% in their revenues. So how's the subsidy calculated? Basically, the subsidy is computed for each claim period and is based on the eligible remuneration paid to an eligible employee in respect of that week in the claim period. Eligible remuneration is defined to include salary, wages, commissions, and other remuneration like taxable benefits, but it does specifically exclude severance and stock option benefits. There are a few areas of uncertainty again with this definition. First off, it's unclear how irregular payments such as bonuses and commissions will be adjusted for in this computation. Also, the backgrounder specifically excludes automobile benefits. However, the legislation doesn't appear to exclude these amounts. Finally, guidance is also needed on more basic issues such as non-weekly payrolls. Well, an eligible employee is generally an individual employed in Canada. The legislation also indicates employees who are without remuneration for 14 or more consecutive days during the qualifying period are excluded. We're going to first discuss the computation for arm's length employees, which is the formula that you see on your screen here. The actual formula is a little bit, it takes a little bit to get your head wrapped around, but at a very high level, the formula is comparing pre-crisis remuneration, or what is referred to as baseline remuneration in the legislation, to remuneration being paid during the crisis. It is in essence ensuring that pre-crisis earnings are taken into account, especially when the employee may have suffered some reduced earnings as a result of COVID-19. So you'll see on the screen, there are two main computations to make, and the greater result of the two computations will be your subsidy. The first computation is relatively straightforward. It's essentially 75% of eligible remuneration paid during the crisis to the employee. The second computation is a least of 75% of the employee's baseline remuneration or pre-crisis earnings, or the actual remuneration paid, which is the remuneration paid during the crisis. All of this is capped by $847 per week as the maximum benefit. So what does this all mean? For arm's length employees who were employed between January and March 2020, the computation results in a potential subsidy of up to 100% of the first 75% of baseline remuneration. For new arm's length employees hired after March 15, 2020, the subsidy will essentially just be the first computation, i.e. the 75% of remuneration paid. As the employee would not have baseline remuneration, the second computation would be none. So moving on to the subsidy for non-arm's length employees, you'll see that the formula is essentially the same as it is for arm's length employees. The main difference, however, I'll highlight. It's only available to those non-arm's length employees who are employed before March 15th, 2020. So in other words, employers will not receive a subsidy on non-arm's length employees hired after this crisis began. The other issue I wanted to highlight was that given the legislation, it appears that non-arm's length employees, if a non-arm's length employee did not receive a salary in the baseline period, or if they're compensated through dividends, they will not be entitled to the subsidy. This has raised quite a bit of concern, and Bruce will be discussing this in further detail as well. So the final piece of the basic computations I want to mention is this new feature that was included in the final legislation, in that the employers can get a 100% refund on contributions paid to EI, CPP, QPP, or QPIP for employees who are on paid leave. This refund will be added to the subsidy paid to the employer, and the refund will not be limited to the $847 benefit cap I mentioned previously. According to Finance's backgrounder, employers should still withhold and remit their amounts as per usual, and they can apply for the refund when they apply for the subsidy. So that, really quickly is kind of all the basics around the computation around the subsidy. There is a lot of detail, and I definitely want to just re-encourage you to read through our blog, as well as look over the backgrounders, and that should hopefully fit all the pieces together for you. I'm now going to turn things back over to Bruce, who's going to talk about some of the significant issues and questions raised with respect to the subsidy. Bruce?
Okay, thanks, Vivian. One other additional point on the calculations of that, the CRA is working on some tools to help businesses and advisors do the calculations as well. So they're actually working on that, I think, almost as we speak. So that's another a tool that should help, I guess, when it's released in terms of doing the calculations, because when you start working through the details, it is fairly complicated. I mean, the concept seems fairly straightforward, but there is a lot of detail and nuance in it. And especially with some of the things I'm going to discuss as well. I think, as Vivian said, the good news is some issues have been resolved, but the resolution also is going to add a bit of complication, which is typically how things work, unfortunately. To have things fixed often means adding more rules. So I did want to talk a little bit about the process we've been using with the issues in a little more depth, just to give you an idea of what we're doing. So I mentioned, excuse me, we're working with the Canadian Tax Foundation, and we've been working to summarize issues on the subsidy specifically. That is one of the two lists that I mentioned at the beginning. And just to highlight, I guess, where we are in that process, we did a summary that's still up on both of our websites, and it highlights the issues that were identified initially. This would be from the backgrounders, but before the legislation was released. Since then, we thought it would be useful to everyone if we did sort of an update to that. Here's a revised listing, and we've highlighted which issues have been resolved, which issues are outstanding, and some additional comments in terms of just practical results arising from that. So we, both ourselves and the Canadian Tax Foundation, that revised list has been posted to our websites. At the same time, we've been getting a lot of new issues coming in. I had a number in my notes that was lower. I think we're right now we're probably around 80 to 100 issues. Frankly, there's a lot coming in, so we're trying to make sure that they make sense and also they're not duplications. But we will have a long list of items before we're done. That's fairly clear. And that leads into the next point. In terms of next steps, we will post a listing of the issues that we've received as soon as we can. It is going to take some time to go through because some of them are fairly complicated. And we're also going to be sharing those with the Canada Revenue Agency as well. We've established a working group with them. And part of the process will be trying to find a way to work on these issues as efficiently as possible, and which issues to take on first, that kind of thing. So we will be in contact on a regular basis with the CRA as well. So as I say, up on the website now is the original issue list with updates, and coming soon will be a more detailed issue list that again, we will have shared with the CRA. So what I wanted to do is give you a bit of an update on some of the key issues that have come up. Some of these have been resolved as I go through them. Some of them haven't, unfortunately. So I think we'll just move into that as the next slide there, Vivian. So there are still some structures that don't appear to qualify as an eligible entity. And we're still trying to see, I guess, is the book closed on that, or is there still an opportunity to discuss some of these situations? So maybe I'll just highlight the ones that are still look as though they're problematic. Uh, uh, One case is indigenous businesses or partnerships. So primarily this would likely be where it's a corporation, because the corporation wasn't exempt under the provision under the section 149. It wasn't the right provision in terms of being an eligible entity. The eligible entity definition mentions specific non-taxable entities, and unfortunately some indigenous businesses aren't going to be included there. Now, partnerships are a problem if you have a partner who's not an eligible entity. So again, that issue would extend the partnerships to the extent that they're partners. Similarly, there's an issue with pension funds, and this would be as partners in a partnership structure, uh, and they're again not eligible, these pension funds, so it puts the private equity partnership fund offside as well. So again, that's a concern. The other thing that's emerging is there are structures out there with public entities that are partners, and again, there are concerns there because despite the fact there's a public entity as a partner, these partnerships are carried on a commercial basis. So again, those entities are trying to seek further guidance from the government as well in terms of whether there's a way for them to qualify. So that's a bit of an update on some of those structures. Now, one issue that was resolved, and it wasn't clear what the background there, because when a reference is made to individuals, generally it's hard to say what the government means. But I guess fortunately, when they did the legislation, it does refer to individuals specifically, which opens up a deeming rule in the trust rules that essentially deems a trust to be an individual in respect to trust property. The deeming is a little unclear when it's talking about trust a little more generally. So although I think the consensus is that trusts are eligible entities, many have suggested, and we will put on our list, that to follow up on trusts just to make sure that they are an eligible entity. Next slide. Another issue that has come up, and some of this relates to questions from our last session and just issues that have come up, and a bit of commentary on the legislation, is the issue around revenue. When we did the initial session, we weren't told a great deal about revenue. Actually, a reference was made to it. The government said that capital items and extraordinary items were excluded, but there wasn't a lot of sort of background in terms of what revenue would actually include. The legislation goes a little bit further. It does say what's included generally, sales revenue from the sales of goods, fees for service, payments for the use of property, fairly straightforward business arrangements. But it is a revenue includes provision that doesn't define it fully. It just tells you what's in it for sure. And as Vivian said, the legislation specifically excludes extraordinary items. So there is still a little bit of uncertainty, I guess, in terms of what revenue actually means. In terms of extraordinary items, they're not specifically defined. So the general meeting would generally apply in these situations. So we would assume that the definition for generally accepted accounting principles should be considered as part of that. The other part is revenue itself, though, doesn't have to be calculated under general accepted accounting principles. You can use the normal accounting method that the entity uses. So that makes it a little more straightforward. I think the key to remember is what the government's trying to do is test the level of business volume. So I think the key thing they'll be looking at, if they were to take a closer look at a client, is just making sure that what you did in the benchmark period is consistent with the period you're comparing to, March, April, or May. So I think consistency is the key there. The other thing that was in the final changes, and this addressed a number of issues actually. There's, as I say, the April 6th list was updated, but you can use the cash basis as long as you use it consistently. And I think that'll help in situations, for example, one of the issues that came up was bad debts. Like, how would that work if you had, your sales weren't maybe down 15% in March or 30% in April or May, but it turned out a large portion of that ended up being a bad debt. It is possible to use the cash basis, so that might be beneficial just generally. And it'll also take care of some more specific issues that were identified. And again, I direct you to the updated summary with some notes there on how the cash method might be beneficial in other areas. Now, one issue that was brought forward, and it sort of arose in a couple of different areas. What happens if you recognize your revenue over time? And one example that was brought forward as part before the legislation came out, I'm not sure this has really been completely dealt with. What happens if, say, you're in the business of providing long-term contracts, for example, and you recognize the revenue over the contract period? The point raised, which makes sense, is if you sort of spread the revenue out, the impact of the downturn may not show itself fully until a number of months have gone by. And the concern was that some businesses that have truly suffered a fairly major loss of business may not qualify because of the revenue recognition method. So again, this might be a situation where the cash method would help. Probably depends on how the payments are structured and that kind of thing, but definitely worth checking if there are situations where revenue is being spread out over time, or if there's other issues about the downturn being immediately impacting the revenue calculation. The other issue that came up was for NPOs specifically, and in terms of recognizing revenue there as well. And again, I think the cash basis plus some other changes that were recommended or were implemented, I should say, for NPOs will be helpful there as well. So again, I'd suggest you specifically look at the legislation in the background or for some more information on NPOs. Now, Vivian mentioned that there were concerns with owner-manager remuneration, and there are a few issues here. Vivian mentioned specifically about the requirement to be employed, but also there's concerns, I think, about just how remuneration's paid, both in terms of the baseline period, because that's part of the calculation, and also the remuneration during the actual benefit period as well. There's a few issues. One might be, is the owner-manager receiving remuneration at all? Or has the owner-manager been receiving remuneration as dividends? Both of those have been concerns. Another concern is how do you sort of allocate the remuneration if it is paid to the various periods during the year? One thing that's quite common for owner managers is to take money in lump sums during the year or as a bonus at the end of the year. And again, how is that going to work when these rules are very granular and go down the weekly pay? So again, I think there are issues around that as well. I think these are issues where there is some leeway for administration as well. So we're hoping that in our discussions with CRA, we can get some more concrete answers on how to deal with some of these things. Another big issue has been just what happens with corporate groups. As Vivian mentioned, the rules essentially say that non-arm's length revenue as the default test is basically excluded. So in other words, if you, in a fairly straightforward example, if you had a manufacturing company that sells all its production to, say, a wholesale company, which sells to arm's length clients, you're going to run into a problem with the manufacturing company and the general rules. Essentially, when you look at arm's length revenue, it'll be 0. If you've been doing business consistently that way, it'll be 0 for the month, the 3 months, March, April, May, and it'll also be 0 for the baseline or the benchmark months as well, either the average of January or February or even the prior year. So this was a significant concern. And other sort of variations, and when you start thinking about it, it's kind of the same issue. Another issue arose if you had a central corporation that provides services to the rest of the group. Maybe it employed a number of employees that worked for various companies, and they were employed by one, and that company provided services to the others in exchange for revenue. Again, that would be non-arm's length revenue and not considered. So the issue when you start breaking it down is you have the arm's length revenue in one entity and the payroll in the other, and that created a problem in many situations. Excuse me. The other issue that arose is we had a number of questions come in about what happens if you sort of went the other way. Instead of having separate companies doing each function, what happens if these different functions or different businesses are inside the same corporation? Can we sort of consider them to be separate entities for the purposes of the calculations? So I think when we get to the next slide on the what happened, there's some good news and some bad news, unfortunately. So dealing with the good news first, basically there's two, in the typical non-arm's length situation, there's two remedies that we're hoping will be effective in a lot of situations. The first is an ability to effectively use the revenue of the other entity. And it's probably easier to talk about this with the example I was using before. There is a formula in the legislation, and it is a little difficult to read. So essentially what the rule says, if in my example, the wholesale manufacturing situation with each in a separate corporation, as long as the manufacturing company's output was sold to the wholesaler, all or substantially all of it, you'd be able to use a different test, which would essentially allow you to revert to the recipient's revenue test. So in other words, the manufacturing company could use the revenue test essentially of the wholesale company. My example is pretty straightforward because there's only one non-arm's length entity and it's selling everything. The formula is a little bit more complicated than that because it brings in the chance that you may be selling to various non-arm's length parties, and also that there could be 10% or less revenue coming in from arm's length sources. So calculation gets a little complicated, but essentially in my example, the manufacturing company would be able to use the revenue from the wholesaler to do the revenue test. So that's one of the possible solutions. The other is an ability to consolidate an affiliated group. So again, in my example, it works out to be, I think, effectively the same, only from the perspective that there's two corporations, but it effectively allows you to consolidate. So the manufacturing revenue essentially gets eliminated on consolidation. Now, if you have more than one entity, or more than two, I should say, if you're getting into multiple entities, you'll probably want to do a little bit of work to see, I guess, for starters, which method's easier, but also where the results, which provide the best results. The one issue about consolidation is if you consolidate the entities, you may consolidate yourself sort of below the 15% or the 30% line. So you may want to look at both rules to see what the results are and decide on which one's better. Unfortunately, for the situation I talked about when you had all these operations in one company, the government hasn't budged on that one. They didn't include anything in the legislation that would allow you to do sort of business line calculations. So, for example, in my manufacturing wholesaling one, even though they'd be perhaps separate businesses, you wouldn't be able to sort of do them separately if it was housed inside one corporation. So unfortunately, that hasn't changed, and our understanding is the government doesn't intend to change that either. One other thing I'd mention just on consolidations as well, there was also a rule that said if a group of eligible entities normally prepares consolidated financial statements, then each member of the group could rely on the revenue from those financial statements if they choose to do it. One thing I would point out as well is we're not sure on how all the elections work here, whether there's going to be forms or that sort of thing. I think the one thing though is consistency will be a key. Each of these special rules requires consistency in terms of all the claims that you make. Okay, next slide. Another issue that arose was around the, we've called it the remaining 25%. In some cases, when you work through the rules that Vivian talked about, there was a situation, perhaps there were situations where you may get a subsidy on the full amount, but not necessarily have to pay the full salary, depending on which, how it all works out. The government had encouraged employers to make best efforts to pay the other 25% of salaries. And that raised a number of questions in terms of what does that actually mean. I think it was meant to be encouraging employers to do it because there wasn't any reference to this in the legislation. Next slide. There are some anti-avoidance rules as well. I did want to touch on those. There's also the usual rules around things like gross negligence and misrepresentation and that kind of thing, which is typical with a number of different rules. I'm not going to discuss that, but I did want to discuss just a few of the anti-avoidance rules just to highlight those. The one with the biggest implication is what we've sort of summarized as a rule to prevent artificial transactions on with respect to revenue. The idea is the government wanted to prevent people from entering into transactions where it's reasonable to conclude that one of the main purposes for doing what was done was to allow you to claim the subsidy. So we don't have examples per se, but I would be concerned about doing any transactions that are non-arm's length that were designed to maybe make the revenue test, for example, work out to your favor. It is a fairly substantial penalty. It's 25% plus the amount that the government believed was improperly claimed. So it could be, in terms of the actual period claim, it could be 125% effectively. You lose the subsidy plus another 25%. So there are also other rules. These are more adjustment rules. The government has said that remuneration, for example, if it's something that's repaid later, again, that'll effectively be adjusted out. And same thing if you try to advance salaries into the benefit period as well. So there are rules around that as well. Next slide. Just in terms of administration, I wanted to highlight a few things. First of all, there is some interaction with other programs. There is still the other subsidy, the 10% temporary wage subsidy. That program is continuing. This is the one where you reduce your source deduction remittances. But amounts claimed under that program will essentially reduce the benefits under this one. And something we highlighted last time, while the 75% subsidy is rolled out, it still makes sense to claim the other one, even if you believe that you'll get the full 75% subsidy. Just on a cash flow basis, you can still be claiming those amounts now, and then you'll reduce your 75% subsidy when you start claiming that. And this subsidy is obviously still available to those that aren't going to meet the conditions for the 75% subsidy. Similarly, the EI work sharing program, the benefits there will also reduce the amount of subsidy under this program. I think this will, I'm sure everyone's aware of this, but just in case, the subsidy is taxable as government assistance, so that should be considered, although it's not considered revenue for the revenue test, which is good because that caused a bit of a circular issue. Another issue to consider, and this one's a little bit different than some of the other things that you see, there's a specific rule in the legislation that says that the applicant will have to have an individual who has principal responsibility for the financial activities of the entity to attest to the application. And essentially they have to say that it is complete and accurate in all material respects. So that'll have to be done as part of the application. Another issue to consider is if the organization doesn't qualify, maybe it's perhaps that the calculations on revisiting them were off or there was an issue, they will have to repay the subsidy to the extent that they don't qualify. And applications will be taken through My Business Account and also an app that they're working on as well. There's a few other administrative things that I'll mention quickly as well. The applications do have to be made before October 2020. And an interesting one, and I think it's something we will follow up with the government, the legislation allows the minister to essentially communicate the identity of claimants. So we are going to see if we can get a little more information in terms of the purpose of that provision, because it is certainly different than other tax provisions generally. And the legislation also allows the minister to extend the program to September 30th, but there's been obviously no word on that yet. Okay, just some final points before we take on some of the questions that we received. Did want to point out again, we have posted two summaries effectively to the website, one on non-tax issues and one on subsidy issues. And the subsidy issue one right now is a sort of a recap and evaluation of the issues that we heard about before the legislation came out. We will be posting a new summary with all of the issues that have arisen since the legislation was released. The other thing I'd mention is that the CRA has updated their tax deadline list on their website. There were some gaps, I guess, when you compared the March 26th stakeholder email and some of the items on the website, but it looks like these have been pretty much trued up now. So there is an updated deadline list. And as a final note, I'd definitely encourage everyone to keep watching our tax update site. I understand we're just past 300,000 visits to the site. So this is where we will be sort of posting updates and things as we learn them. So as I said, on questions that we get, we unfortunately can't answer specific questions, but we will be trying to provide as much information as we can through the tax update page. So Vivian, I think we're probably ready to take some questions.
Thanks, Bruce. So we have a number of questions and we kind of narrowed them down to some of the most common ones we've heard. So the first one is, if I put employees on unpaid leave at the outset of the COVID-19 crisis, but now would like to return them to paid leave retroactively and pay them retroactively, would that still qualify for the subsidy?
Yeah, and this is a question that a number of people are talking about. Essentially, I think one of the things that the government has talked about repeatedly is that the program is applies beginning March 15th. And, you know, the issue that came up for a lot of businesses was that they had to make immediate business decisions. And, you know, they had to base it on what was known at the time. So the question that's sort of come up is, if I'd known how the program was going to work, essentially, maybe I wouldn't have put these people on unpaid leave. So is it possible to go back and do essentially what I probably would have done if I'd known all the details? And the answer, it's probably a two-part answer. The legislation appears to not prevent that sort of that approach. The concern, though, we have is that we do think that it would be important for the CRA to comment on that. And we have forwarded that question as a specific ask to the CRA, and we've been told that they're taking a look at it. So we think it's important for an issue, because this could involve a lot of money. We feel that it's important that a question such as this should be answered by the CRA and posted on their website. So we are in discussion with CRA in terms of giving them what they need to know and asking them to do an update.
Great. So next question, Bruce, is what kind of supporting documentation will be required for the revenue test? What will we have to disclose when applying?
And that's a good question, because it really depends on how much the CRA wants to take in as part of the application process. So I think that's probably the starting point of the answer, is what details will be needed to actually make the application. As I mentioned, the CRA is working on some tools, and it does look as though they're trying to assist you with the calculations. So if that being the case, it looks as though you'll need to be sort of armed with all of the details to make the application. Obviously, you'll have to have all the payroll and that sort of thing as well. So we'll have to see when the application app and the My Business Account page come up in terms of what details they'll ask for. But I think that would be the starting point. Beyond that, we will ask, and it will be on our issue list, to ask the CRA what sort of documentation should be kept. I think the one issue that we already touched on was the fact that the weekly or the program is based on weekly pay periods. All of the legislation and the background or talk about how much it is per week. And one issue we said specifically was, so what happens if you pay, say, semi-monthly or every 2 weeks or something like that? So again, that might be part of the documentation as well. So we'll have to see, I guess, as we go forward, but it's certainly an issue we've asked CRA about, or we will ask them about when we submit the list.
Okay, great. So the next question, if the employer's decline in revenue is off of what is required by the revenue test, does that employer have to repay the full amount of the subsidy, or just a portion they were perhaps off by? For example, if their May 2020 revenues actually ended up declining by only 20%, not the required 30%.
Yeah, it does seem to be an all or nothing test, and that does raise issues, I guess, in terms of how you approach it. Some businesses, it'll be pretty straightforward whether they qualify or not. You know, a lot of retail businesses have had to close down, and if they don't have presence on the internet, they may have seen a significant reduction in business volume. So some of those businesses should know fairly black and white terms whether they qualify or not. I think the larger concern is probably around those that are closer to the 30 or the 15% test, depending on which month you're looking at. I think those claims, this is where you want to be a little more careful, because if it turns out there's an issue or something that wasn't considered when the application was made, you do have to repay it, and it could cause cash flow issues.
Okay, great. So it was mentioned in the presentation that if an entity meets the revenue test for period 1, that entity is deemed to qualify for period 2. What happens in period 3?
So there was a rule, as you say, there's a rule that essentially allows you to qualify for period 2. Our read is that for period 3, you'd have to go back and reapply the revenue test. Again, it'll depend, I guess, on how straightforward the situation is. For some businesses, it might be very straightforward because it's very black and white that they're well in excess of the reduction needed to qualify. But again, for other businesses, they'll have to be ready to do a more detailed calculation. You will have to submit information regularly to CRA, so it's really more of whether you actually have to meet the revenue test. And like I say, for period 3, you will, and for period 2 in that situation, it's a carryover from period 1.
The next question, for professional services firms, does revenue include WIP?
Yeah, that's been a common question. I think there's a couple of pieces to this. I think one of the issues we found a few years ago when or I guess it was 2 years ago when the WIP issue came up, the change in the legislation, I think there was a bit of a misunderstanding generally in terms of work in progress. It is under the Income Tax Act inventory. So I think that is one item to consider. So, you know, is the amount that you have as inventory relevant for a revenue calculation? A lot of firms book revenue for accounting purposes based on a billed basis, and then they do the adjustments they need to for tax purposes at the end of the year. It appears that billed basis would be fine, although given that a lot of people wanted more guidance in general, we are going to put it on the list of the issues to follow up on. The other thing I'd mention as well that professional firms, as others can, they can also look at the cash basis as well, in addition to just revenue under normal accounting methods.
Right. Okay, so that takes us to our last question, Bruce. If I elect to use the cash basis, do I need to report my revenue for the prior reference period using the cash method as well?
Yeah, so the answer to that, as it is with a lot of these things, is consistency. So once you pick a rule, you have to follow it. So, and that's the same as for the cash basis. So once you start using the cash basis, you have to stay with it. And the other thing I mentioned is the government really wants to see if there's a reduction in business volume. So you need to be consistent. So you will have to look at the prior period as well, whether it's the 2-month average for January or February or the corresponding month last year. Now, one issue that you may want to consider is more of a practical issue too with the cash basis. The one issue that came up in our original list, and it's still, I think it's more of a concern about how do you deal with it as opposed to the government maybe telling us how to do it, because the issue is kind of the issue. And the issue is this, that a lot of smaller businesses really didn't do monthly cutoffs consistently, perhaps, for revenue. You know, especially for smaller businesses, if they're annual filers for GST, the number for the year is really the important one and not necessarily how it breaks down per month. So if there were concerns about how cutoffs were done for revenue last year, especially because no one knew that they would have had to do accurate cutoffs, the cash basis might be an easier way to document what really happened, because you will be able to go back and document what cash went through. So, you know, that may be an easier, that might be a different approach that might make sense in those situations as well. But to answer your question, you do have to be consistent once you start.
Great. Well, thanks, Bruce. That actually takes us to the end of our presentation today. I hope you found it helpful and provided you with a little more clarity than perhaps you started off with before the session. As you can tell from the presentation, there's still a lot of areas of uncertainty, and there will be a lot of questions, especially as the administration of this new program is rolled out. So, as we mentioned a few times in our presentation, continue to check our website. We're going to be posting relevant and significant updates through that channel, and we'll keep you apprised in that way. So thank you for joining us today, and have a good day. Thank you.